Today, we will talk about future value, definition, formula, how to calculate, example, and uses. Future value is a value of a current asset at a future date, based on an assumed rate of growth. This is important to investors and financial planners, as they use it to estimate how much an investment made today will be worth in the future. Knowing the future value enables investors to make sound investment decisions based on their anticipated needs. However, external economic factors, such as inflation, can adversely affect the future value of the asset by eroding its value. Future value can be contrasted with present value, PV. The future value calculation allows investors to predict the amount of profit that can be generated by different investments. The amount of growth generated by holding a given amount in cash will likely be different than if that same amount were invested in stocks. Therefore, the future value equation is used to compare multiple options. Determining the future value of an asset can become complicated, depending on the type of asset. Also, the future value calculation is based on the assumption of a stable growth rate. The future value formula assumes a constant rate of growth and a single upfront payment left untouched for the duration of the investment. If an investment earns simple interest, then the FV formula is FV equals I times, where I equals investment amount, R equals interest rate, and T equals number of years. For example, assume a $1,000 investment is held for 5 years in a savings account with 10% simple interest paid annually. The FV of the $1,000 initial investment is $1,500. With compounded interest, the rate is applied to each period's cumulative account balance. The formula for the FV of an investment earning compounding interest is FV equals I times T, where I equals investment amount, R equals interest rate, and T equals number of years. Using the above example, the same $1,000 invested for 5 years in a savings account with a 10% compounding interest rate would have an FV of $1,610.51. Future value can be useful in some situations. However, there are limitations to the calculation, and it may not be suitable for use in some cases. The concept of future value is often closely tied to the concept of present value. Both concepts rely on the same financial principles and are related. The future value formula could be reversed to determine how much something in the future is worth today. The Internal Revenue Service imposes a failure to file penalty on taxpayers who do not file their return by the due date. If a taxpayer knows they have filed their return late, they can easily calculate the future value of their owed taxes based on the imposed growth rate of their fee. Consider another example of a zero-coupon bond trading at a discount price of $950. In 2 years, the future value of this bond will be $1,108.08. Here are 4 key takeaways. 1. Future value, FV, is the value of a current asset at some point in the future based on an assumed growth rate. 2. Investors are able to reasonably assume an investment's profit using the FV calculation. 3. Determining the FV of a market investment can be challenging because of market volatility and uncertainty about future investment conditions. 4. There are 2 ways of calculating the FV of an asset, FV using simple interest, and FV using compound interest. Hope this would help. Thanks for watching.